Your application triggered an identity flag, and the bank isn't going to tell you what that actually means. Most people assume a denial comes down to credit score or income. Sometimes it never even gets that far. There's a verification layer running before your credit score is factored in at all. Here's the part they aren't telling you. That layer can kill an application in seconds, with a perfect score sitting untouched in the background. Think of identity verification as the bank's automated process for confirming you are who you say you are, using data sources completely separate from your credit file. That process is called identity verification cross-checking, and it runs the moment you hit submit. In plain terms, before the bank even looks at whether you can repay a loan, it's running a background check on whether your identity itself looks legitimate. Here's how that actually works. The system pulls your name, address, date of birth, and social security number, and cross-references them against multiple independent databases simultaneously. One of those databases is a KYC system, Know Your Customer, a set of identity verification checks banks are legally required to run under anti-money laundering law. KYC isn't optional, it's federally mandated. Every regulated bank has to run it on every new applicant, every time. Put simply, this isn't the bank being suspicious of you specifically. It's the bank being legally required to run this check on everyone, and your file either passes cleanly or it doesn't. Here's where the identity flag actually gets generated. The system checks address stability, how long you've lived at your current address, and whether that address matches other filings tied to your name. It checks synthetic identity markers, patterns that resemble identity fraud, like a social security number that doesn't align chronologically with your reported age or credit history length. It checks device and application velocity. How many other applications have come from the same IP address, device fingerprint, or browser session recently? That's not a guess. That's how fraud detection engines are actually built. They're looking for statistical patterns, not judging your character. Most people hear fraud detection and assume it doesn't apply to them. Don't make that assumption. A recent move, a name change, a shared household device, or applying for multiple accounts in a short window can all generate a flag completely disconnected from anything on your credit report. In plain terms, the system isn't asking, does this person deserve credit? It's asking, does this application pattern look statistically normal? And normal is a moving target you can't see. Here's what that actually means for you. If your identity flag trips, the application can auto-decline before a human underwriter ever reviews the file. A fully automated rejection based on pattern matching, not judgment. That's coming up next. The specific companies running this check and the legal framework that lets them operate with almost no visibility to you. LexisNexis Risk Solutions and Socure are two of the largest identity verification vendors banks use for this exact cross-check. A risk score in this context is simply a number these vendors generate estimating how likely an application is to involve fraud or misrepresented identity, built from address history, device data, and public records. Strip away the banking language, and here is what is actually happening. A third-party company you've never interacted with is generating a number that can override your entire application, and you have almost no way to see that number in real time. Here's the legal reality behind this. The Bank Secrecy Act and related anti-money laundering regulations require these checks. That's the compliance framework banks are operating under. Because it's framed as a compliance and fraud prevention requirement, not a traditional credit decision, it does not carry the same adverse action disclosure obligations as a standard credit denial. Here's the friction point. A bank has to tell you if your credit report caused a denial. It does not have the same clear-cut obligation to explain that an identity verification mismatch caused the blockee, because legally that's classified as a security process, not a lending decision. That's not a guess. That's the exact regulatory gray zone this entire system operates inside. Most people hear this and move past it. Don't. This is why some viewers get denied instantly with no derogatory marks anywhere on their credit file, and no clear explanation ever provided. Here's the systemic reality tying all of this together. Your application isn't evaluated by one system. It's evaluated by a credit engine and a completely separate identity verification engine running in parallel, and either one can end the process independently of the other. The credit repair industry built an entire framework around fixing your report. Almost none of it addresses this identity layer because it isn't a credit issue at all. It's a security and compliance issue wearing the same denial letter. In plain terms, a clean credit file protects you from one type of rejection. It does nothing to protect you from the other. This channel exists to map that second system, not to tell you how to beat it. To show you exactly how it's built so an instant denial stops looking random and starts looking like exactly what it is, a machine doing precisely what it was designed to do.